Look at your markets now. Asian stocks weaker as risk aversion prevailed this morning due to mounting concerns over the Middle East. Gold is staying up near those 2-month peaks, with investors seeking safe havens. In Japan, the Nikkei fell almost 2%. In Hong Kong, the Hang Seng fell 2.4%, and the Shanghai Composite on the mainland in China down almost 2%. Overnight, Wall Street ended the session sharply lower as investors assess the latest batch of earnings. All eyes are on the Fed Reserve Chair Jerome Powell, who's expected to speak later on interest rates. Tesla CEO Elon Musk says he's concerned about the impact of high interest rates on car buyers. The Dow Jones fell 1%, the tech-heavy Nasdaq down 1.6%, and the S&P 500 falling 1.3%. Now, markets in Europe are in the red as concerns about the Middle East weigh. Investors have also been adjusting their expectations today about the possibility of an interest rate cut. Bond yields have pushed higher, and when that happens, buyers are looking for more interest than simple savings accounts when they think interest rates will stay higher for longer. The JSE, as you can see behind me, has not been spared. The all-share down nearly 8% earlier, 0.75% lower. What's being reflected in these numbers is that investors are looking for safe havens once again. So that includes gold that I said earlier is still near those 2-month highs. The dollar also trading up, and the rand has weakened. You'll see it's trading well above 19. There it is at 19.06 to the dollar after it opened below 19 rand to the dollar this morning. At home, of course, poor retail sales data not helping. But let's look at the big picture, since we are often at the mercy of big global flows. From the UAE, we're now joined by Chief Market Analyst for Xfinity, that's Han Tan. Han, thank you for being with us. Let's start with interest rates. What are you expecting to hear from the Fed Chair Jerome Powell later on?
In short, nothing new. I do expect Fed Chair to persist with that higher for longer mantra, and some of his colleagues have been, echoing as much in recent weeks. Now, I think it's about being data dependent, right? So the Fed has said they are watching and waiting for incoming data on inflation in particular, and also, of course, around the jobs market to dictate their next steps. So I don't expect anything too jarring out of Chair Powell later today.
I mean, this whole idea of higher for longer, at one point, a lot of investors were saying, we're looking to when interest rates will come down. What's the expectation now? Is the middle of next year still a vague possibility or not?
Yeah, so as things stand right now, markets expect that rate cut to occur in the second half of 2024. But keep in mind, even that timeline has been pushed back compared to the rate cuts that were initially expected, perhaps even at the tail end of this year, right? So there is this constant reaction to not just the Fed's policy outlook, but also how the U.S. economy develops, right? So in other words, this resilience that we have seen in the U.S. economy really since even before the summer, I think that's caught out not just policymakers, but also markets as well. So markets are readjusting to these newfound reality, which is informing their outlook.
Yeah, and that's an irony in a way that interest rates will stay higher for longer. There will be more economic pain because the U.S. economy is actually looking pretty healthy, isn't it?
Yeah, it is. And to be clear, even though there are expectations for a U.S. recession, and that is still the base case for many, it's not expected to be a protracted one, nor is it expected to be a deep recession, right? So there's bound to be some pain, as you say, or a reaction in the U.S. economy as it buckles or potentially, show some cracks under the weight of this really aggressive rate hikes by the Fed that we've seen since last year. But I think once the Fed senses that inflation can sustainably remain under control, I think the Fed has got no qualm, or at least it's got a lot of bandwidth to then start cutting interest rates.
Elon Musk yesterday said in response to Tesla missing expectations that he's concerned about interest rates and the effect on car buyers. So do you think some companies are feeling it in the way he suggests, or is that an excuse?
Oh no, I think those are very real concerns, right? I think it's only it's finally catching up. The economic realities are catching up to the likes of Tesla, which had seen or been spoiled with superior growth in recent years, right? So I think the economic realities are there. Now for investors, it's perhaps about looking for those stocks that or sectors that have more of a buffer against these economic realities, meaning they are able to withstand these headwinds and still preserve their earnings moving forward. I think, and a lot of focus is on big tech, but whether or not they can deliver for Q3 and beyond, we will find out actually pretty soon in the days and weeks ahead.
All right, before we let you go, to what extent is the Middle East and concerns about a possible extension of the conflict weighing?
Yeah, I think it's weighing especially more on certain asset classes. So, for example, as you rightly pointed out earlier, gold has been elevated because of those safe haven bids, and that's despite Treasury yields still staying higher. Right, oil, of course, showing a tremendous amount of sensitivity to this geopolitical conflict. But stocks, I think it's added to the worries for stock markets rather than being the primary driver, because I think stock markets are still very much focused on the Fed's policy outlook, right? But if anything, this Middle East conflict is just adding to their wall of worries.
All right, a wall of worries. Thank you. Han Tan, Chief Market Analyst for Xfinity from the UAE. Let's take a short break. More to come on Point.